We received an email from a listener who's in a bit of a predicament. They bought a stock at $100 a share, and now it's trading at $50. They're hesitant to sell, convinced it will rebound eventually. They're emotionally attached to the company, and the idea of realizing that 50% loss is really tough. This touches on what our reference article calls the disposition effect, the tendency to hold losing stocks too long and sell winners too early. Sam, what are your thoughts on this? At what point does hope become denial in investing?
Hope without a solid basis becomes denial. It's crucial to distinguish between optimism based on sound analysis and wishful thinking. A price drop doesn't automatically signal a bad investment, but clinging to a loser without reassessing the underlying fundamentals is dangerous.
That makes sense. So how can investors differentiate between a temporary dip and a fundamental problem with a company? This reminds me of when we talked about market cycles in episode 38. Downturns are inevitable, but some companies don't bounce back.
Exactly, Taylor. A temporary dip might be due to broader market fluctuations, short-term negative news, or even just normal price volatility. A fundamental problem, however, impacts the long-term viability of the business. Think of it like this. A dip is a pothole in the road. A fundamental problem is a washed-out bridge. You can drive around a pothole, but a washed-out bridge requires major reconstruction.
That's a great analogy, Sam. So looking at the company's financials, their competitive landscape, and their overall strategy is essential, especially when a stock experiences a significant drop.
So, if I understand correctly, if the company's core business model is still strong and the price drop seems unrelated to its long-term prospects, it might be a temporary dip. But if the drop is due to, say, changing consumer behavior that directly impacts their revenue streams, then it's potentially a fundamental problem.
Precisely. Let's say a company relies on a specific technology that's quickly becoming obsolete. That's a fundamental issue. Conversely, a short-term supply chain disruption while potentially impacting earnings might not be a deal breaker if the long-term demand for their product remains robust.
This connects back to our discussion about having a clear investment thesis. You should have a rationale for buying a stock in the first place. If that rationale is no longer valid due to fundamental changes, holding on to the stock becomes more about avoiding the pain of a loss than about sound investing. So, to recap, clinging to losing stocks based on hope alone can be detrimental to your portfolio. Differentiating between a temporary dip and a fundamental problem requires carefully examining the company's prospects. Taylor, any final thoughts?
I think the analogy of the pothole versus the washed-out bridge is incredibly helpful. It's a reminder that you have to assess the situation, not just hope for the best.
Great point. Our call to action for this segment is to review your investment thesis for any stocks that are significantly down. Ask yourself, are the reasons you bought the stock still valid? And consider setting stop-loss orders to limit potential losses in the future. This can help take the emotion out of selling decisions.